students who just joined us. Okay, I just want to know, can you all see my slides? If you can just give me a thumbs up or a yes. Yes, you can. Okay, great. Okay, guys, so this week, as I said earlier, we are going to concentrate on capital allowances. So it's very similar, and it's the same concept as depreciation as what you did, what you do in accountancy. The only difference is the rules are slightly different, as well as the terminology we use. So you'll see as we're going through it, the terminology is a bit different. For accountancy, for example, you say depreciation, whereas for tax we say like wear and tear, section 12C allowance, so we name it different. Okay, but the concept and the underlying principles are very, very similar. All right, so it's actually a fun section, capital allowances, and it falls within gross CGT, capital gains tax. So that is when we start selling the asset. So it's the same concept again as accounting. When you sell an asset, what happens? We just have separate rules for it in tax. All right, so before we start with the different sections, it is important that you understand these definitions. Now, I'm not going to tell you in a test, please give me the definition of a machine or a plant or a depreciable asset. I will never do that, but I'm sure at this point in time, you do understand more or less what these definitions are. Okay, so just know them and understand them, but please, you don't have to learn them off by heart. Okay, so for tax, machinery is machines or their part taken collectively, the mechanisms or work of a machine or machines, a system or a kind of machinery. Now, it's quite a big definition, okay? So basically, machinery is any machine that you use within your business. That's what it comes down to, okay? Plant is fixtures, implements, machinery, apparatus used in the carrying on any industrial process. So that is important. When you see plant, you know that there's an industrial process happening. So it's not like your ordinary business. Maybe for example, maybe you're selling groceries. That will never be plant, right? Maybe if you're manufacturing vehicles, or you're manufacturing, I don't know, microwaves or something like that, that could be, those machines can be seen as plants, okay? Process of manufacturing, I think you all know this word by now. You've all done costing, okay? I think you all understand what process of manufacturing is, but it denotes it's an action or series of actions directed to the process of an object or thing, which is essentially different from the materials or components which went into the process. Now, I think by now you should know raw materials go through and at the end product is a final product. So, for example, let's say we want to manufacture a car door, okay? They will put it from the beginning, the raw material, and then this machine will most probably make the car door, shape it, and at the end of the process will be a car door, okay? So that is quite easy. And then a depreciable asset, okay? So you've seen this word in accountancy, right? What does that mean, depreciable asset? Does anyone want to tell me what does depreciable asset mean? Okay, welcome to raise your hand, or if you want to put your mic on, you're also welcome to do that. Depreciable asset, what does that mean? Anyone, guys? Don't be shy.
Ma'am, I would try and
Yes.
say that a depreciable asset is an asset that is able to be depreciated. So basically an asset that's available for use, and therefore you can apply the depreciation variables in order to determine the methods and then depreciate it.
Okay, so correct. So you're allowed to write the asset off in essence, right? So you're allowed to write the cost off. So yes, you are correct. Thank you. Okay, so depreciable asset is property of whatever nature, movable or immovable. So that one's an easy one, right? A vehicle in a business is movable. The microwave in the canteen is movable. Okay, immovable is your land. such things like you cannot move. Your buildings is immovable. Corporal or incorporeal. So corporal means something you can physically touch and feel. So like a laptop, a desk, any asset within the business that you can see, feel, or touch. Incorporeal means you cannot see it. So what type of assets are those? Those will be things like shares. Okay, dividends. Well, dividends is the income, but shares is your asset, for example. Okay, interesting. It says excluding any currency, but including any coin made mainly from gold or platinum. So, yeah, so a depreciable asset does not include the money within the business. Okay, I think that is understandable, right? Money comes and goes in and out. But why do they specifically include a coin made mainly from gold or platinum? Because these type of coins are coins that people use to as assets. So they will keep it, and then maybe in 4 or 5 years' time, when the value grows, they will sell their coins. A good example of that is a Kruger coin, most probably. So those type of coins are seen as assets. Okay. And then it says the second bullet, it says a right or interest of whatever nature to the above. So what does this mean? If you have a right to an asset within a company, it is also seen as a depreciable asset to you. All right. Now, at this level, in diploma level, we don't really cover this one, the second bullet, but we do cover the first bullet, right? So it will be very obvious in a test. We will speak about a laptop or a vehicle or a building. So you'll be able to identify what is depreciable, etc. All right. Then it says it excludes trading stock or any debt. Okay, what is the reason for that? Because as you have seen already, you've already done trading stock, right? So for tax purposes, trading stock has got its own tax rules and debt as well. If someone is owing you money, so especially when, for example, trade debtors, okay, this is one of your special deductions. Debtors, they owe us money, it's got a special tax rule. So therefore, it's excluded from the depreciable asset. Why? Because it's got its own tax rule. Okay, then it says it qualifies for a deduction or an allowance that is wholly or partly based on its cost or value. So very important, there has to be a value to the asset or a cost price. Okay, so this is just general definitions, and I'm sure by the end of this class, even by the end of the slide, you will all understand what it means. Okay, you have come across it through your years of studying. Right. So before we start with the actual assets, I am going to cover repairs with you now. A repair is actually a special deduction, but the reason I cover it in under capital allowances, it's because it actually fits in with capital allowances, with your capital assets. That's the reason we cover it under this section. Okay. So a repair is not deductible under Section 11E, under Section 11A. Why? Because it's capital in nature, right? So if you have to look at your general deduction formula, okay, it's like any expenditure or losses actually incurred. The last one says excluding capital in nature amounts. So a repair is seen as capital. Why? Because it's once off. Okay. However, Section 11D allows it. So there's a special deduction. So just like you did with special deductions, what most of the special deductions, I would say 98% of them are seen as capital, but then there's a special provision that is given. And that special provision allows the deduction now. Okay. So repairs will be deducted under Section 11D, but with anything, whenever there's deductions, there must always be requirements, okay? So it's pretty obvious when you do gross income, literally everything is included. The only thing that's not included is something that's capital. But when we want a deduction from SARS, there's always extra requirements, okay? So they try and avoid people just deducting anything they want. That's why there's a lot of requirements. So let's have a look. When are we allowed to deduct a repair? Okay. Section 11D allows a deduction for the cost price of the repair if it is expenditure actually incurred during the year for the repair of property occupied for the purposes of trade or for the purposes of repairing machinery, implements, utensils, and other articles used by the taxpayer for the trade, for purposes of his trade. So it's very broad and it's very specific. Number one, it has to have actually been incurred. Okay, so you actually did the repair during this year of assessment. Okay, and number two, the next one, for trade purposes. So whenever you look at a repair, always ask yourself, was the repair done this year of assessment? Because remember, with a deduction, if you do not claim it the year that it's actually incurred, and you want to claim it next year, you actually lose it. It has to happen during this year. If you do not put it through, unfortunately, next year you'll lose it. You cannot say, oh, I forgot to put that repair in last year. You've lost it, okay? So it has to happen within this year of assessment and actually incurred. All right, so that is what's important. And the third important requirement is for the purposes of trade. Okay, whether it is property or you're repairing a machine or a laptop, it does not matter as long as it is done within your business. Okay, that is why, let's say the business owner wants to repair his microwave he got from home, for example, and then he puts through the repair through the business. So he buys the part and he puts it through his books. Is that allowed? Yes or no? What do you think? So the owner of the business brings his microwave that he uses at home to be fixed at the company. And he orders the parts and he repairs it. Okay, at the company. Is that repair deductible? Yes or no? No, it's not deductible. Why? No, because it's not for the purposes of trade. So it is for private use. So any deductions used for private use will never, ever be deductible. All right, so well done. Okay, then I see there is a question here. Let me just read it quickly. Okay, an asset that loses value over time. Okay, that was for depreciation. That is correct. Then someone asked, if it is capital in nature, is this section, it's not deductible. Okay, so I'll speak to that one now. So meaning capital in nature, if it's capital in nature, basically it's not deductible under the general deduction formula. But now there's a special deduction. So what SARS is saying, yes, it does not fall under the general deduction formula that you did with Mrs. Esterhazen a few weeks ago, general deductions. It does not fall under that formula. Why? Because it's capital in nature. But then we take one step forward and it says SARS is saying, right, even though it's capital in nature, I will still give you the deduction if the requirements are met. Okay, so I hope I answered that student that asked the question. Okay, so those are the requirements that need to be met, actually incurred during the year for the purposes of trade. Right, then we deducted. If it's not for any of those guys, no deduction, capital in nature, no deduction at all. All right, so let's just go through what is a repair, and you will see, I'm sure you noticed when you did gross income and general deduction, in tax is a lot of case law. And the reason there's a lot of case law is because sometimes certain parties will take, or certain companies or individuals even take SARS to court to fight something. SARS will say, no, we believe it's not deducted, but maybe the individual will say, or the company will say, no, we believe it is deductible. So what happens is cases like this will go to court, and from that court case, sometimes new tax rules are actually implemented. All right. So you guys do not need to know court case, but sometimes it is nice to read through it just to get an understanding of, okay, how do they actually reach this conclusion? It's interesting sometimes. Okay, so, and to classify what is a repair and what is an improvement, that was a big thing. And that is a court case. You can even read it in your textbooks. It was an interesting case where the taxpayer felt that it was a repair, but SARS felt that it was not a repair, it was an improvement. So it was like capital in nature. It was part of the cost price of the asset. Yeah, and as a taxpayer, the bigger deduction you can get now, the better for you. So as you know, a repair is a special deduction. So that means if I repair a machine and it costs me 15,000 Rand, I can get the deduction this year of assessment. But if it's an improvement, what's going to happen? It's going to be capitalized to the cost price of the asset, and the asset will then be written off over a number of years. So yes, we will get the deduction, but through the depreciation, through the allowances, it will come out slowly. Okay. So that is why taxpayers want it to be a repair. Why? Because we get the deduction immediately. Okay, so what is a repair? It's basically a restoration by replacement of a subsidiary part of the whole. Now, please, you don't need to know that off by heart. Basically, what it means, you're replacing a part of an asset. That's what it means. Replacing materials need not be the same as original. This is a very, very important point here. Okay, does not need to be original. Now, I think that is a valid point because let's say I have a machine from 20 years ago and this machine is strong and it's still going. 20 years later, it needs a repair, but that part, specific part, is no longer available. Why? Because they manufactured this machine 20 years ago. Now there's more newer, updated machines out there. So yes, there's a high possibility that that part will not be, they won't be able to find the part. Why? Because it's an old machine. So that is one of the requirements. It says the material does not need to be the same as the original. Okay, why? Due to old parts not being available. All right. But what happens if this new part now, because the old part does not exist, but there is a new part, okay? And what happens if that actual new part actually makes the machine work even faster and we produce more income? So I just want you to think about that. So it's a new part. We can't get the old part, but now this new part has actually made this machine run faster and produce more income. So hold that thought in your mind, right? I'm going to ask you another question on that just now. Then it says a repair is different from an improvement or a renewal. A renewal is a reconstruction of basically the whole part. So maybe 70 to 80% of the whole machine is nearly repaired or reconstructed. That is seen as a renewal, not just a small repair. An improvement is the creation of a better asset with the possibility of an improved income earning capacity. Now, that is important. If I'm going to improve something, it's because I want a better working asset. It's because I want an asset that will produce, like maybe I'm making shoes. I wanted to produce more shoes in an hour. So I want it to work faster for me. I need to produce more income. Okay, so the main difference is with a repair will restore an asset to the original condition. So if I'm doing a repair, I just want my machine to work as it was working before it got damaged, right? If I want an improvement, it means I want a better working asset that will work faster and I can generate income faster. So that is the two differences. Okay, so my question to you is now, earlier I said the part does not need to be the same. So let's say that we cannot find parts anymore for that machine, but this new part that I bought automatically makes the machine work faster. Will that still be seen as a repair or will it be seen as an improvement? What do you think? So remember, a repair, original condition, an improvement, the asset works better. So do you think the repair will still be seen as an improvement or it will still be seen as a repair? Now you need to put yourself in those shoes and say, right, what was my intention, my original intention? Was it to repair or was it to improve the asset? And that will give you the answer to your question, to the question. What do you think, guys? Improvement, improvement, improvement. Okay, I've got a hand. You may answer for the person raising their hand.
Hi, ma'am. Thank you so much for the space. When you speak about intention, the last time we did intention, we had to distinguish between something was of revenue in nature or capital in nature. So I wanted to
Correct.
ask, with the intention of us repairing, right? I mean,
Yes.
with us trying to distinguish whether it's a repair or an improvement, if the intention behind it is to repair, does that mean that it's a repairment? Or if the
Correct.
intention is that what it is? We have to always look at the intent.
Yes. Correct. So
So
you are 100% right.
all right. So even if the newly repaired asset does increase my sales or improves the how the machine works, if the intention was to repair, then it's a repairment.
100% yes.
Thank you so
That's
much.
100%. So yes, you got it. So yeah, well done. So it's still seen as an improvement. Why? Is it my fault, the taxpayer, now that now just because a part is not available, now it's my fault that this cost must be capitalized and I'm not going to get my full deduction now because it's not a repair. Now it's going to be capitalized, but it's going to be depreciated. So I will get my deduction, but on a very slow basis, right? Every year I'll get a certain percentage written off. So as the taxpayer, it will still be seen as a repair. Why? Because they will ask you, what was your initial intention? And because my intention was just to fix it so it can be working in the same ordinary way, but now it's not my fault, it's out of my control, it will still be classified as a repair. All right. So just to sum up this section, it's pretty easy. A repair is a special deduction, so we're allowed to get the deduction. If it is an improvement, the improvements will be capitalized to the cost price of the asset. Okay, remember a repair, we're just repairing, we want the asset to work in its original condition. That is the whole purpose of a repair. Okay. Now, in your textbooks, you will see on page, now I took the snapshot. This was from, I think, 2023, but anyway, it's the same question. There's no difference. The only difference is the year of assessment, but it's exactly the same concept, okay? So if we look at this question, it says, yeah, okay, let's start from the top. Mr. Crew owns a house which he purchased as an investment to earn rental income. So immediately you need to stop there and you say, hang on. So this individual purchased the house to earn income. So what does this mean now? This house is used in business now, right? Because I'm using the house to earn rental income. It's not my private home anymore. Now it's seen as a business basically business opportunity, and you're using this home to earn income. Okay. For the year end, 28 Feb 2022, he supplies you with the following information. So here we got rental received. Everyone happy? Rental received will be included in gross income, right? It's income he received. Now let's look at the next 4 or 5. It says the cost of scrapping old blistered paint off the outside walls and stripping the woodwork. So now you've got to sit and think, okay, so the cost of scrapping old blistered paint off the outside walls. What do you think is his intention here? Do you think he wants it to look like it used to look like? Or do you think he wants to make it even look better? Please tell me. Okay, while you're thinking of that, let's continue. The cost of filling all the cracks in the wall and the woodwork, the cost of repainting the walls and the woodwork. So what does that mean, repainting? It means that it used to be painted, right? Now we're taking off all the flakes off the wall and now we're going to repaint it. Okay, so let's look at those 3. Do you think that is classified as a repair or an improvement? What would you say? Okay, his intention is to repair. Yes, repair. So the intention is to repair and to make it basically look how it used to look before it started cracking and the paint started peeling off. So 100% that those 3 costs are definitely repair. Okay. So if we look at the solution here, we see rental income 72, and then B, C, and D will definitely be a repair. So remember, a repair, 100% deduction the year that it is incurred, 100% deduction. Okay, let's look at number E. The cost of installing a sprinkler system for the garden. Do you think this is a repair or an improvement? So an improvement will also be a new asset, basically. The cost of installing a sprinkler system for the garden. What would you say? An improvement, 100%, definitely an improvement. Did it say anything that he had a sprinkler system before and now he needs to fix it? Nothing of that sort. They just said he's installing a sprinkler system, so that is seen as an asset. Okay. So, your sprinkler system is an improvement, therefore you're not allowed to get the deduction now. Obviously, over the years you will be able to depreciate it, but for now you cannot deduct the whole price. Okay. Then the cost of a burglar alarm. So this was 15,600. So it says the burglar alarm control box was faulty and resulted in many false alarms. So there was a problem with it. The parts needed to repair it were no longer available as it was very old. A completely new control box was connected to the existing system at a cost of 15,600. The new control box uses less electricity than the old one, but it performs the same function. Please tell me, this new alarm system, is it a repair or is it an improvement? What would you say? It's a repair, okay? Now, why do you say it's a repair? Because now you're looking at what was the intention, correct? You're looking at, so it says here the burglar alarm control box was faulty and it resulted in many false alarms. So there was a problem with it. Then it said the parts that were needed are no longer available because it's very old. So what was the intention? The intention was to fix the alarm. So there's no faulty alarms anymore. That was the main intention. But it's not their fault that there's no available part for it because it's old. So what happens? They have to put a completely new control box. They don't have an option. And obviously the new complete box now, it uses less electricity. So yes, we're happy, we're going to gain. But that was not our intention. Our intention was not to put a new box. Our intention was to fix it. But because there was no part, we had to put a box. So we don't have the option here. So for this one, it's definitely going to be capital in nature. A repair, section 11D, 100% deductible. Everyone happy with that? Okay, so I'm reading some of the comments here. I see some people put an improvement. And then the last one said an improvement because it uses, I'm sure you're meaning it uses less electricity. Okay. But what is that? Was that the intention to put in a new electric box? That was not the intention. The intention was to fix the old one. Okay. But automatically, because there's no parts, we have to put a new one. And because the intention, so now we go back and we look at the intention. What was your main intention? It was for a repair. Therefore, this is seen as a repair. It's a special deduction. You can get 100% deductible. Happy on that one for the student who said it was an improvement. Okay, there's a hand up. You may ask your question.
Ma'am, the question I have is like, let's say, for example, the intention is to repair the asset, but you have options to return it to its condition or to improve it. And then you choose the option to improve it. Is it still considered to be a repair or an improvement?
Okay, that will be seen as an improvement because if you have the option to repair or improve and you go the improvement route, that means your intention is to improve it. Then your intention has changed now. So your intention is to improve it. So then the cost will be seen as capital in nature and it will be capitalized as an asset now. Happy?
Yes, ma'am. Thank you.
Okay, welcome. Okay, there's another question. You may ask your question. Okay, then I've got a question here in the chat. How can the entity prove that the intention was for a repair if the repair resulted in an improved functionality of the asset? Okay, so how can they prove it? Well, number one, if there is, for example, if you've got quotes, because now you're going to search for quotes. So a lot of the time you will email different companies asking them for quotes. Okay, so now this is a case where, let's say you put it as a repair, but now, for example, the company puts it as a repair. Now every year you do e-filing, right? You need to do your tax returns. And now SARS asks you, they red flag it and they say, this is a repair. Can you prove that this amount was a repair? So that is why it's important whenever you claim a deduction, whether it's a special deduction or what general deduction, it does not matter. You always have your proof. So as a taxpayer, if you're going to have someone doing your taxes, they need to understand these concepts, okay? So you know that this is a special deduction. Now there's quite a big amount there. SARS is going to query it. You need to have proof. So automatically you would have sent emails to different companies asking them for quotes on this part. And a lot of the time they will come back and say, oh, sorry, we don't have that part, but we can offer you this part. Maybe it's an old. So you have to prove to SARS that it's a repair. You have to prove that unfortunately we could not get that part. That part is old. We've emailed a lot of suppliers. There's all the proof. Therefore, we had to buy a new one, and it's not our fault that it's working better now, but our main intention was for repair. So always remember this, students, no matter what, whenever you claim a deduction, always be prepared to have to show SARS proof as to why you are deducting an amount. Okay, so for that student that asked, I hope that answered your question. Okay, then the next question is there a limit on the value of the replacement item? No, there's no limit there. So it can be, it depends on the asset. I guess it depends on the repair as well. There's no limit there. Okay, so that's basically repairs. Okay, so in a nutshell, a repair is easy. You will be able to identify if I'm speaking about a repair in a test or the exam. I will tell you machine X broke down and had to be repaired, and then I'll give you background information, and then you need to decide, okay, is it a repair or is it not a repair? And then you need to know repair is a special deduction, 100% deductible. Okay. Okay, so now we're going to start looking at our acids. So today we're going to cover 2 acids, and then after recess, we'll do the next acids. Okay, so the first one is capital allowances, section 11E, wear and tear allowance. So we call this section 11E. I think by the end of today, you're going to know section 11E, okay, and section 12C. You will automatically know those ones. So what type of acids fall within section 11E? Machinery, implements, utensils, and articles. Now, if you look at that, it basically means everything, right? It's really like, what is articles? What is utensils? I mean, it's broad definition. So I always tell students, when you look at a section 11E acid, number one, it must always be a movable acid, okay? Laptop, desk, chair, machinery, anything that is movable within your business, okay? Number two, it must not be machinery used in the process of manufacturing. So it can be any machinery, but it must not be used in the process of manufacturing. Process of manufacturing is the next section, okay? So it's a very general section. Anything that is movable and that is not used in the process of manufacturing will fall under section 11E. Now, when am I allowed to claim an allowance for this type of acid? Number one, I must own the acid. The taxpayer must own this acid. And it must be used by the taxpayer for trade purposes. So that acid, I must use it in my business, in trade. During the year of assessment, very important. I have to use that acid during this year of assessment if I want to claim a section 11E allowance, okay? So 3 requirements. Number one, the taxpayer must own it. Number two, it must be used by the taxpayer in his trade. And number 3, it has to be used during the year for me to claim this allowance. Right, so what is the difference here between tax and accounting? Now, we say section 11E, wear and tear allowance. For accountancy purposes, you would just say depreciation, but the concept is the same. So what is the difference between tax and accounting? Accountancy, you say depreciation. Tax, we say wear and tear allowance, or we say Section 11E. Same thing. When do you start calculating depreciation in accountancy? When it becomes available for use. But when do we start calculating wear and tear in tax? Only when we bring it into use. That is a big difference between tax and accounting. We only start calculating allowances when we bring it into use. So you could have bought this asset 2 years ago and it's just sitting there in your storeroom. You're not using it. That means you're not allowed to claim for tax purposes wear and tear. Okay? Only when you start using it, then do you start calculating wear and tear. Okay, another important principle for accountancy purposes, you say book value. So who can tell me what is book value in accountancy? What does that mean, book value? Can anyone tell me what that means?
The price in
What
which we acquired the asset for.
the price in which you bought the asset for?
Yes.
Okay, so that's basically your cost price. Okay, so you're halfway there. So it's basically, okay, the student put in the chat, cost less accumulated depreciation. So it's basically the value of the asset on a certain date minus all the depreciation, right? Cost less accumulated depreciation. So that's the calculation. But what does it actually mean? It actually means this is the value of my asset that still needs to be depreciation. It's basically the balance of the value that still needs to be depreciation. So it's like your carrying value. That is correct. Okay, your carrying value. So for tax purposes, we don't say book value, we say tax value. So what does tax value mean? It means it's the same concept. It's my cost price minus my wear and tear allowance to give me a tax value. So in words, what does it actually mean? It means the cost price that still needs to be written off. Everyone with me? And I always say this to students is when you study tax, don't study something off by heart, but study it with understanding. Because if you understand a principle, no matter what question we give you, you're always able to answer it. So it's just like this tax value and book value. A lot of students will give me the calculation. They'll say cost minus depreciation, cost minus wear and tear. But what does that value actually represent? It represents the balance of the cost price that still needs to be written off. Okay? So you will see what I mean when I say don't study things off by heart, study with understanding. Okay, so that's just a bit of difference between tax and accounting, but you can see it's very similar. Okay, so let's look at section 11E. Sorry, students, just give me a few seconds. Okay, sorry about that. Okay, so under section 11E, there's certain rules that need to be applied, okay? And a lot of this is also very similar to accountancy as well. So when we look at a cost, we say value. Now, when you see value, that means you can either use the cost or the market value. So what does that mean? If I don't give you a cost price, automatically you will use a market value, okay? So that is why we say value of asset. So what does a value include? It can include direct cost, installation cost, erection cost, foundation or supporting structures, and moving cost. If there's no direct cost of an asset, then the value will always equal to the market value. So can you see, very similar to accountancy, any direct cost, if you had to move the asset and you had to hire, let's say, a moving company, a crane to move this asset, that cost will be included in the cost price of this asset now. Okay, so any cost dealing with this asset will be capitalized, even if it needs a special foundation or it needs a special supporting structure, for example, that will all be included in the cost price of the asset. All right. And then we've got VAT. Now, VAT is a very important principle as well. Sorry, students, just give me a minute. Okay, sorry about that. Okay, so let's look at VAT. It will always exclude VAT. Now this is a very tricky one because it depends. It doesn't mean it will always exclude VAT. So can anyone tell me when will a cost price exclude VAT and when will we always include the VAT? Anyone know? Because I'm sure you have done basic VAT. Anyone want to try? Correct, 100%. It excludes VAT if it's a VAT vendor, and if it's a VAT vendor, we include VAT. Okay, 100%. So that's 100%. So if I tell you I'm purchasing this asset from a VAT vendor, okay, it's going to include VAT, correct? But now you need to ask yourself. So there's one more step to that. You need to ask yourself, am I a VAT vendor? Because if you are a VAT vendor, that means you can claim the input tax on it, correct? But what happens if I purchase from a VAT vendor, but I am not a VAT vendor? I cannot claim it. So what happens? Automatically, I have to include the VAT in the cost price of my asset. Why? Because I cannot claim it. I'm not a VAT vendor, so you cannot claim. Okay? But the concept is, yes, if you're buying from a vendor, obviously they will charge you VAT. If you're not buying from a vendor, they're not going to charge you VAT. But the main principle is, when can you as a taxpayer claim that VAT or not? You can only claim it if you are registered. If you're not registered, you will always include the VAT in your cost price. Why? Because you cannot claim it. Okay, so that's VAT. Then it says it excludes finance and interest charges. Yes, very important. For tax purposes, finance and interest charges are taxed separately. So you will never ever include finance charges and interest charges in the cost price of an asset. So remember that. Moving cost. Very important. What happens if I have to move from one factory to another? So 5 years down the line, I decide I'm going to move now, factory. And this specific asset is extremely heavy and we need to move it, and we need to get trucks in or hiring companies in. The cost of moving that asset, that moving cost, will always form part of the cost price of an asset. So my question to you is, what happens if that asset is completely written off already and now we decide to move? Do we lose out on the moving cost or do we still capitalize it? What would you do in this case if the asset is completely written off? What would you do with that moving cost? Anyone want to try? Okay, we expense it. Okay, so basically, yes, you will get the full deduction. You will put an expense. The reason why is because the asset is already written off. So now you're allowed to get the full deduction. But remember, that cost will still form part of the cost price of the asset. So it won't be an expense on its own. You will still put it part of the cost price of the asset, but you will write it off 100%. Why? Because the asset has already been written off 100%. Okay. So yes, you get 100% deduction. I just see a comment here. So we would exclude VAT if it's not a VAT vendor. So as a student asked, we would exclude VAT if it's not a VAT vendor. Well, you wouldn't just automatically do it. Whatever you paid for it wouldn't include VAT anyway, because that vendor is not a VAT vendor. So you're not going to include it. They wouldn't have charged you VAT. So that price excludes VAT anyway. Okay, if you're buying from a non-vendor. Okay, so moving costs, yes. What happens if the asset is partly written off, guys? What happens then? Okay, if the asset is partly written off, you won't lose it, but what are you going to do? You're going to work out the remaining life of the asset, and then you will calculate your wear and tear on the remaining life of the asset. So let's say the asset is written off over 10 years, and now you've already written off 5 years, and now you're moving. You need to ask yourself, how many more years do I have to write off this asset? We have 5 years, therefore we're going to write it off over the next 5 years. Okay, the remaining life of that asset. That's what you would do there. Okay, improvement. Well, an improvement will always increase the cost price of an asset. If I decide I want to improve my building, or, okay, building is a wrong example to use here for Section 11E, but let's say I want to do improvements to a machine or a vehicle, for example, of my delivery vehicle. I want to make it look nice and I want to improve it. I want to put an extra exhaust so it can run faster, or whatever the case may be. That's seen as an improvement. It will be capitalized to the cost price of an asset. Foundation and supporting structure will increase the cost of an asset that is subject to wear and tear if. Okay, so this is an important one. So a lot of times an asset needs a foundation in order to work, or a supporting structure. Now, if you're going to make a special structure for this asset, and you are going to say, oh, SARS, we believe that this structure belongs to the, it's part of this asset, you need to prove that. So in order for this asset to work, it needs the structure to be in place. So you'll have to prove that, right? So when are you allowed to include this structure as part of the cost price of the asset? Number one, it must be designed for that asset. So basically, only that asset can use that structure. I cannot make one structure and say, oh no, this structure will be used for all these assets. That means it's actually a standalone asset, okay? If it can be used for multiple assets, it's seen as a separate asset then. All right. So for it to be part of the cost price of one asset, it has to be designed specifically for that asset and constructed in such a way that it is regarded as integrated with that asset. So when I look at that asset and I look at that structure, I can see that it all works together. That structure is needed for that asset to work. Okay? And the useful life of the foundation or the structure will always be limited to that of the useful life of an asset. Well, that will be obvious because we're going to include that cost price in the cost of the asset, and we're going to write it off as one. Okay, so there will never be tricky questions on this, guys. Just know if you see in the question that there's a foundation that had to be made and the foundation cost, I don't know, 100,000 and the cost price of the asset is 200, always know that you must add them together and it's seen as one asset. All right. I just want to see any questions in the chat. No. Okay, let's continue. And then the last one here, I call this the golden rule of Section 11E, right? It's always there, so you must always look for it. Assets costing less than 7,000 Rand, we see them as small items, will be written off in the year you acquired it and you bring it into use. So very important. And this is what taxpayers like. Why? Because now they're going to get a bigger deduction in their tax return. So you must remember, as a taxpayer, you sit with your gross income, right? You try your best to reduce that gross income. Why? Because the higher your taxable income, the more tax you're going to pay, right? So if I can get that gross income down through my deductions, that is what taxpayers try and do. So if I buy an item, an asset that is less than 7,000 Rand, I can get a full deduction in the year. It's a special rule for Section 11E. Okay, very important. The asset must function in its own right, and the asset cannot be part of a set. Very, very important. So let's say you buy a boardroom desk with 6 boardroom chairs. And you say you bought it together, like it was, they sold the table and the chairs for 10,000 Rand. Everyone happy with me that is seen as a set. You bought it as one asset, okay? Now you are clever, so you decide, you know what? I'm going to split the cost and I'm going to tell SARS I paid 5,000 for the table and then maybe, I don't know, 900 for each chair. Is that right? Yes or no? So you bought it as a set, but then you're going to say that it's not a set. You bought it separately. Is that right? No, it's not right. Okay. Why? Because now you're trying to avoid tax in an illegal manner. Okay. So meaning avoid tax, meaning you're trying to reduce your tax, but through the wrong way. Okay. So that's what it means when it says it cannot be part of a set. So I cannot go say, no, this was 10,000, but if I break it up and I say this chair's no, unfortunately, that does not fall under small items. You're not allowed to do that. It must function in its own right. So if I tell you I bought a microwave for the canteen for my staff to use and it's 4,000 Rand, that's not part of a set. It's a small item. I get the full deduction when I start using it. Okay. If I tell you that I bought a boardroom table at, let's say, Game, but then I bought the chairs at Macro. Would that be seen as a set, guys, or can it be seen as a separate asset? So the desk as a separate asset, one chair as a separate asset, one chair as a separate asset. What do you think of that? Okay, if I buy the desk at Macro and then I go and I buy the chairs at Game or whatever, separate asset, 100%. Okay, it will be seen as a separate asset. Why? Because I've got separate invoices or receipts for each item. It's seen as a separate asset. Okay, I see there's a hand up. Would you like to ask a question?
Yes, ma'am. Hi. I have two questions, right?
Yes.
The first one is regarding can't be a part of a set. What would happen
Okay.
if the set is actually less than 7,000?
If the set is less than 7,000, it's seen as a small item. You get 100% deduction when you bring it into use.
All right. And then my second, so it's not a question, but it's a plea. May you please repeat point number 4, specifically the partially written off, if whether we're talking about it being deductible or we're talking about it being capitalized. Because I know you
Okay.
said that when it's written off, we're going to obviously deduct, it's going to be deductible at 100% of the cost, right?
Yes.
And then when it's partly written off, I wanted to understand the allocation part.
Okay, so remember, we're speaking about costs being capitalized, right? So if I'm going to capitalize this moving cost to this asset, I need to ask myself, okay, has the asset been written off or not? Because now this cost it forms part of that asset, the cost price of the asset, right? So let's say the asset has got a lifespan of 5 years, and I've already written off 2 years, and now I decide to move. How am I going to write off that moving cost now? Because it's an integrated cost with that asset, right? So you need to ask yourself, how many years do I have to write off the asset? I've got 3 years. Therefore, that moving cost must also be written off over 3 years, the same time as that asset. Why? Because it's part of one cost price now. Do
All
you
right. So we,
understand?
yes, so we deducted on the remaining useful life.
Remaining useful life, 100%, yes.
Thank you so much.
Okay. Okay, guys, so you were all right to say that it's not a set. Okay, what if you buy the table and the chairs item by item from the same shop and bought it on different days? Is it still a set? Well, I guess on this one, you can decide on that. If you got different slips and you pay one chair for one, a slip for one chair, a slip for another chair, and you can prove that it's actually, you didn't pay it as part of a set, and you can prove it to SARS, then you can see each chair, each table as a separate asset, as long as you can prove it. All right. So what happens if it's not part of a set? Then you're going to take the boardroom. Let's say the boardroom desk cost 8,000 Rand. Everyone happy? It's not a small item. I can't get the deduction immediately, right? I'll have to write it off. But each chair maybe cost me 1,000 Rand. Then each chair you'll write off 1,000 immediately as soon as you bring it into use. Okay, so this is a nice section for small items. Always look out for it. It's always tested. Okay, so those are the small rules around the cost price of an asset that falls within section 11E. Now, how do we write it off? Okay, so that's also important. How do you actually write off this asset? there is specific periods that is given for specific acids, okay? Now, we will always give you this in a test. It will always say SARS allows Section 11E or wear and tear write-off period, and we will tell you laptops is 5 years, vehicles is 4 years. So this information will always be given to you, okay? We always use a straight line method. So in the textbook, they also have the accumulated depreciation method. You don't have to worry about that. We always use straight line. Very important, we apportion for the year. So if you only use the asset for a portion of the year, you're only going to get a portion of the allowance, okay? So let's say I used it, my year end is in December, and I only started using it from the 1st of August. You will only get August, September, October, November, December, 5 months worth of allowances. The write-off period is different from each type of assets. I already mentioned, I will give you that information. What about used assets? Write-off over the remaining lives of the asset. So this one is an interesting one when it comes to used assets. What do they mean by used assets? It does not mean second-hand assets. Okay, I can buy a second-hand asset, I'll still get the full write-off period. But what this means is you owned this asset before, then you sold it. Now you say you bought it again, and now you want to write it off again. So what used to happen, and it happened a few times before this rule came into place, is taxpayers were clever. So they would be like, okay, I'm going to say that I sold this asset, but you really don't really sell it. And then in a year's time, I'll buy it again. Why? To start claiming the allowances again. So you would have written off the asset, now you buy it again, now you want to claim it again at cost price. Okay, so it's not right for tax purposes. That is not right. That is why they say if you've used that asset before, so let's say I sold it last year. When I sold it, I only used it for 3 years, but the life of that asset was actually 5 years. So what it means is when you sold it, you already wrote it off for 3 years. Now you're buying it again. You're only allowed to write off the balance of that first cost price over 2 years now. You're not going to get the full cost price again and start writing it off from the beginning, okay? So it will always be asked then, okay, I used the asset 3 years ago, and I only wrote off 3 years. Now I'm buying it a year later because I sold it. That means I can only write off the next 2 years. And that is on the balance of the actual cost price, the original cost price. Okay, so just to let you know, just be aware of it. We do not test this principle in the diploma level, but it's always nice to be aware of it if you further your studies in that, just to be aware of that one. Okay, so let's have a look at a question. It says X Limited acquired a vehicle. So is a vehicle, the first thing you ask yourself is a vehicle a Section 11E asset? Well, number one, is it movable? Yes, it's movable. And do I use this in process of manufacturing? No, I don't use it in the process of manufacturing. Therefore, it's Section 11E. Okay, so that is how you need to think when you're asking yourselves, what section is this asset in? So we bought it for 100,000 Rand on 1 March 2024. And we brought it into use for the first time on 1 December 2024. The write-off period of this vehicle is 4 years. X Limited financial year ends on the 31st of December each year. So my question to you is, okay, let's read the required first. Calculate the capital allowances to be claimed by X Limited for each of its year of assessment, 2024 and 2025. So can you tell me for 2024, how many months are we going to claim an allowance for? For the year 2024, so remember when I speak about a tax year, it's always 12 months, right? So if I tell you the year ends on the 31st of December, can you please tell me what 12 months am I looking at during this tax year? Can anyone tell me? So I'll tell you the year of assessment is 2024. So what will be the first day of my year of assessment? You can type it out or you can Put your mic on and tell me. 1 Jan. Correct. The first day of my year will be 1 Jan 2024 to 31st December 2024. So that is the tax period I'm working in. So I want to know from you, okay, on the 24th, on December 2024, how many months am I going to claim an allowance on this vehicle? Can you please tell me? How many months are you going to claim the allowance for? 1 month, okay? 1 month, correct. Now, I know how you told me it's 1 month. Why? Because for tax purposes, we only start calculating wear and tear when we bring it into use. Even though we purchased it in March, we never used it. We only started using it on 1 December. So therefore, we only calculate an allowance for 1 month. Okay, what about for 2025? How many months are you going to calculate the allowance for 2025? Can you please tell me? Is it 1 month? Is it 12 months? How many months for 2025? 12 months, right? Because we assume that nowhere in the question did it say we stopped using it. So we assume that we continue to use it. Okay, correct, 12 months. Right, so let's have a look at the solution. For 2024, we brought it into use on December 2024 only. Therefore, same as depreciation, guys. Can you see? 100,000 divided by 4 years times 1 over 12, and that is my allowance that I get. So remember, an allowance is a deduction, okay? 2025, I get the full year's allowance, 25,000. If you prefer to work in percentages, it's the same thing. You wouldn't say 4, but you would say 25%. Okay, so some students like working in years, some students like working in percentages. You get to the same answer. Okay, and that is section 11E, guys. It is a very basic section. If I have to summarize it for you, it is very, very simple. Section 11E is only for movable assets, okay, that is not used in the process of manufacturing. So that is a long list. Laptop, desk, chairs, microwave, it can go on. Whatever is movable asset in your company that is not used in the process of manufacturing is a Section 11E allowance. Okay, cost price. If I don't give you a cost price, you will use market value automatically. What happens if I give you the cost and the market? You will always choose cost. Cost is number 1. Okay, if I only give you market, you only use market. Okay, another important principle is I will always give you the write-off period of this asset, and it is always apportioned. So if I only use it for a part of the year, I only get the allowance for the part of the year. That is the main concept of Section 11E. All right. The last one we're going to do today, and it's a simple one, is Section 12C. And this is for movable assets used in the process of manufacturing. So basically what it is, it's all the assets that don't fall under Section 11E, all the assets that are not movable, that are movable. Let me say that again. All the assets that are movable but are used in the process of manufacturing. Okay, so you already know what process of manufacturing is. It must be a complete process. It must be continuous. There must be no break. I think you all know what that means. There must be an essential change from material. Material going in, raw material is an end product. But again, I'm not going to ask you what the definition of this is. I think you all already know what process of manufacturing means. Okay, so let's look at Section 12C. When is Section 12C applicable? Plant or machinery used directly in the process of manufacturing. Okay. Again, it must be owned by the taxpayer. It must be brought into use, and it's also applicable to improvements that we know. That's for every asset that you have. So what is different here compared to 11E? There's one difference. These assets will always be used in the process of manufacturing. Okay. So I'm not going to ask you the requirement. You need to know these requirements to determine, am I dealing with a Section 12 asset or Section 11E? Section 12C, why? Process of manufacturing, plant or machinery. Okay. Now this section, when it comes to cost, it's a bit tricky. Okay, so just pay a little bit of attention here. The rule says the cost price of this asset will be the lesser of the actual cost or the market value. But very, very important, there has to always be a cost price. So what do I mean by that? If I give you cost and market, you will choose the lesser one. Okay, that's number one. If I only give you cost, you will use cost. But what happens if there's no cost price and there's a market value? That means you're not allowed to use Section 12C allowance. Why? Because the rule says there has to be a cost price. So the asset must have a cost. The asset must have a cost, therefore not applicable to assets acquired at no value. For example, if someone donates an asset to me, I do not pay for it, there's no cost price. And I use this asset in my process of manufacturing. Because it does not have a cost price, I cannot claim Section 12C. Okay? But SARS is generous here. SARS says it's okay. Even though you cannot claim Section 12C, SARS will allow you to claim it under Section 11E. So very important, and make a note on this, that if this comes up, you know that it's no longer a Section 12C asset. Automatically now there's a special rule that says it will be 11E. Okay, so I'm going to repeat it one more time. The rule says it will always be the lesser of cost or market. So if I give you cost and market, you always choose the lesser amount to be the value of this asset. Okay. If there is no cost price, you cannot use Section 12C. Then you're going to tell me in your answer, because there's no cost price, this asset will be now Section 11E asset, and now you will apply the rules of Section 11E. You're going to write it off over the given years. I will give you that information. You're going to apportion it for the number of years, months you use it, etc. So you will use Section 11E rules when it comes to this asset. Okay, so that is very, very important. So I just want to note just want to check if there's any questions on this. Okay. Okay, can you all see my screen on slide 13 now? I see there's a student that can't see the slide. Okay, you may ask your question. I see there's a question. Okay, so the students are saying yes, they can see my slides. So I think for the students saying they're still stuck on slide 10, maybe your screen has frozen or something. Okay. All right, guys. So please think of this rule here. If you're a bit confused, maybe during our face-to-face class this week, you're welcome to come and see me and just if you need to understand it better. Okay, then the next rules, guys, is exactly the same as Section 11E. There's no difference. It will exclude VAT if you're a VAT vendor. Okay, it will include VAT if you're not a VAT vendor. So remember, if I buy from a VAT vendor and I'm not a VAT vendor, I cannot claim it. It will include it. And so the opposite will apply. Indirect costs of installation and erection costs will also form part of the cost price of the asset. Financial charges and interest charges will be excluded. Foundation structure, exactly the same as Section 11E. Moving cost, exactly the same as Section 11E. So can you see the cost price of a Section 11E asset and the Section 12C asset is exactly the same. All these costs are the same. The only difference between Section 11E and Section 12C is the actual cost when we decide what are we going to use. Okay, so that is important. So the best way to study this is to take a paper. You're going to split it with 3 columns. You'll see when we come back from recess, we're going to do another section. It's called Section 12E. So you leave that for the last column. You take a big piece of paper, you put Section 11E, Section 12C, Section 12E. You're going to put the similarities between the 3 sections, and then under that, you will put the differences. It's very easy to study in that way. Okay. Now, how do we calculate the the allowance we get from a section 12C acid. Okay, so there's two rules here. I will not give you the write-off period. You need to know the rules for section 12C. Okay, so the first one says you will write it off at over 4 years, 40% in the first year, then 20% in the next 3 years. So it's a 4-year write-off period. When are you allowed to claim this? Well, again, the acid, you must own the taxpayer must own the acid. It must be used in the process of manufacturing and only when you bring it into use. Okay, I already mentioned this at the beginning. And you will only claim the 4-year period if it is a new and unused acid. That's the only time you claim over 4 years. The second option is over 5 years. So that's going to be 20% per annum. And when do you use the 5 years? If it is a second-hand acid and it is used. Now, this first one here, it says new and unused. So let me give you an example. Let's say the company next door bought an acid, a machine, process of manufacturing machine. They bought it 2 years ago. But it's been sitting in their storage for 2 years. Still in the box, hasn't been opened, it's still sealed. And now they come to me and they say, you know what, don't you want to buy this machine? We're actually not using it at all. So I decide to buy it. Please, can you tell me, will that acid, am I allowed to write off that machine over 4 years or 5 years? 4 years or 5 years, what do you think? Okay, there's someone that said 5. Why do you say 5? Okay, someone said 4. So for the student that said 5 years, I would like to know why do you say 5 years? Because it's secondhand. Okay, so let's go back to the slide. So the person that said 4 years, you're correct, and yes, 4 and unused. Okay, so what does it say here? New and unused. So what does that mean? If I buy an acid, a machine, from someone that has never used it, it's still classified as new. Therefore, I can claim the 4-year write-off period, 40/20. And this was actually a court case that a company took SARS to court to say that they believe that their acid must be written off over 4 years because they bought it from another company that never ever used it and they brought it. So it's still seen as a brand new acid. Okay, so that is where the unused word came from actually a court case. Okay, but thank you for your answer, students. So I hope the student that said 5 years understands now. It's not seen as secondhand. It's still seen as new. Why? Because it was never opened. It's still in its packaging. It was just owned by someone else. It was never used. Okay. Okay, so in a question, you need to identify, am I going to use 4-year or 5-year write-off period? How do you know that? You need to ask yourself, is it a new acid? Is it unused? Or is it a second-hand acid? Very, very important. We do not apportion this allowance. So even if you use that acid for 1 day in that year of assessment, you will still get the full 40% or the full 20%. You don't ever apportion the allowance, okay? Then it just says, yeah, this does not apply to small business corporations. You don't have to worry about that one now. We will be doing small business corporations after recess. Okay, so let's go and look at a question. It says here, X Limited acquired a new machine for 100,000 Rand on 1 October 2023 and brought it into use for the first time on 1 December 2023. The machine was used in the process of manufacturing as defined. So my question to you is, what type of acid is this? Is it a section 11E or is it a section 12C acid? Can you please tell me?
Well, she.
12C. Why do you say 12C?
Because it's an asset that was used in the process of manufacturing.
Happy. Process of manufacturing is your keyword there. It's a movable asset, therefore, section 12C. Okay, I see there's a question here, a comment. Under section 12C, only we don't apportion. Correct. Only section 12C, you do not apportion. 100% right. Okay, so when you read a question like this is how you need to think of your answer already. Number one, what type of asset is this? It's a section 12C asset. Now you need to apply the rules for section 12C. So now you're going to say, am I going to write it off over the 4-year or 5-year period? What are you going to use? Can you tell me 4-year or 5-year period? How will you write it off? Over 4 years or 5 years? 4 years. I will say over 5-year. Okay, why is it 4 years, guys? It's 4 years because it is new. So remember on this slide, I use a 4-year write-off period if it is new or unused, and I use 5-year write-off period if it's second-hand. Okay, so this question, it says it is a new machine. Therefore, I know it's going to be written off over 4 years, okay? So in the first year that I bring it into use, I'm going to write off 40%. Now my question to you is, in 2023, I only brought it into use on 1 December, but am I going to apportion for 1 month? Yes or no? No, you're not. You're going to collect the whole amount, right? Why? What does the rule say? No apportionment. So the only thing I need to look at for is, when did I start using it? I started using it in 2023. Therefore, I can start claiming my allowances in the year 2023. It doesn't matter if I used it for 1 day, 10 months, 2 weeks. It's irrelevant. As long as I used it, I can claim the allowance. Okay, then it says the financial year is 31 December. Calculate the allowances from 2023 to 2025. Okay, so here is my solution. In 2023, I'll get 40%. Why? Because it is a new asset. 100% times 40%. 2024, 2025, I'll get 20%, 20%. And when will I write off this asset? It will be completely written off by 2026, right? Because in 2026, I would have written off the balance of the 20%. Okay, so basically that is section 12C. So section 12C and 11E go hand in hand. How do you know which section to use? Well, it's simple. Both of them are movable assets. The only difference is 12C is relevant only for manufacturing assets, whereas section 11E is all movable assets, excluding manufacturing assets. Okay, for section 12C, remember, when it comes to the cost price, it will always be the lesser of cost or market value. There has to be a cost. If there's no cost, immediately you will say no section 12C, apply section 11E rules, and you will write it off according to section 11E write-off periods. Okay, with section 12C, you will not apportion, and for section 12C, you need to know the 2 write-off periods. And that is the main rules of section 12C, guys. Any questions on your side?
No, ma'am. Thank you so much.
Yes.
No, like no questions. Thanks.
Okay, you're welcome. Okay, so I started off just with two sections, and I think you guys will understand it. So it's basic sections. So please come to class. We will do a question on these, and also I will also in class just give you a breakdown on where you are in tax. You know, what you have done from class 1 to where we are now. So you understand where does capital allowances fall on, you know, from where you started, from deductions, gross income, so you can see where you are. Okay, so it's very simple section. So please make sure you understand it by the end of this week, by the time you come to your face-to-face classes, that you understand these 2 sections. Because when we start again, it's just going to be building blocks now on the basics. All right. Otherwise, guys, I will stay here for the next 5 to 10 minutes in case students want to ask questions. But if you have no question, you are welcome to leave the online class, and then I will see you in the face-to-face class. And also, please remember, for the students that are attending the Thursday class, please remember only for this week, your Thursday class will now be on the Wednesday in your practical class time. Okay, so there will be no tax lecturing on Thursday, but you will still have tutorials. So for the students attending your tutorial on the Thursday, that will still go on. Okay, it's only for the face-to-face tax lecture on a Thursday that is moved to a Wednesday. I did put an announcement on that this morning on Moodle. All right. Okay, so I've got one question here. It says, ma'am, there's no cost price. What do we do? I'll answer that now. Can you please repeat what you said about the cost price? Okay, not a problem. I'll answer that. So let's go back to the slide. Okay. So this is for section 12C, right? So the rule says it will always be the lesser of actual or market value. So in a question, if you see that there's a cost price and there's a market value, then for tax purposes, the value of that asset will be the lesser one. So let's put amounts to it. Let's say the actual cost is 100,000 and the market value is 120,000. What would be the cost for that asset? Can you please tell me? So actual cost is 100 and market value is 120. What would you use in your calculation? 100,000. Okay, so I think everyone understands that principle. We will use the 100, the lesser one. Then there's another rule that steps forward and it says, according to this section, there has to be a cost price. If there's no cost price, you're not allowed to use section 12C. So for example, let's say I tell you in the question that an asset was donated to your company. The market value of that asset, and this asset is used in the process of manufacturing, the market value of that asset is 120,000 Rand. So now you need to sit and think, hang on, but section 12C says there has to be a cost, and now I don't have a cost. It's just giving me a market value. So can you use section 12C in this scenario? Yes or no? No, you're not allowed to use section 12C. So what does the rule say then? The rule says, okay, no cost price. So now I have to use section 11E. So now you go to section 11E and you go check, right, machinery. What is machinery written off? It does not matter that it's used in the process of manufacturing anymore. That does not matter. Why? Because I did not fall within section 12C, automatically I can use section 11E rules. All you need to now ask yourself is, okay, now this asset is section 11E. What is the write-off period? Oh, it's 5 years. Now I must apportion for the number of months, and you use those rules. Okay, so it will no longer be section 12C asset. Now, in your question bank, there actually is a question on this. So please take note of it when you're going through questions. When you'll do the questions only after recess, okay? So that's what that means there. What happens if I just give you a market value and I say the market value of this asset is so much? Same principle, guys. You can't use section 12C. Why? There's no cost price. If I just give you a cost price and I don't give you a market value, well, that one is an easy one. What are you going to use? Your actual cost price. All right. So it's pretty simple. Basic rule, lesser of cost or market. If I don't have a cost price at all and I only give you market, you cannot use section 12C. You have to use section 11E. So I don't know, is that clearer? Do you understand that better? Okay, you can ask your question for the student who had her hand up.
No, ma'am, you answered it. Thank you.
Okay, do you understand? Okay. Okay, please repeat the moving cost rule on written off asset. Okay. Then the next one, thank you, I understand. Okay, you're welcome. So when it comes to moving cost, so remember when we were speaking about costs, we're speaking about costs that can be capitalized to the cost price of an asset, right? So now we're looking at a cost that's going to form part of an asset. But remember, when it comes to capital assets, you write them off over 5 years or 4 years. So now I'm sitting with this cost that has to be capitalized. Now, accordingly, if it is a capital asset, I'm allowed to get an allowance, correct? But what happens if that capital asset is already written off? It's not being, there's no more allowances, it's written off already. Is it fair now that I lose that moving cost because now that asset has been written off? It's not fair, right? Because that moving cost actually forms part of the cost price now of that asset. So now you need to ask yourself, if it's already written off the asset, what does that mean? It means that I can get the full deduction of that moving cost. So it will be 100% deductible. Why? The asset's already been deducted. I can get 100% deduction now. But if the asset is not fully written off, so let's say the asset has got a lifespan of 5 years, 2 years have gone past, and now I decide I'm going to move it. The day you move it, you need to ask yourself, how many years are remaining for this asset to be written off? It's only going to be 3 years. So therefore, the moving cost will be written off over 3 years. It's going to be written off at the same time as the asset. Okay, so I'm not sure, do you understand better for the student who asked about the moving cost? Okay, yes, you understand. You're welcome. Okay, then there's another question. It says, so if the lesser of the cost is the market value, do I still apply section 12C? Yes, or 11E. No, you will apply section 12C because the rule says you must choose the lesser of cost or market. If the market is lesser, you will still apply section 12C. You will use the market value. The only time you use section 11E if there is no cost price. That's the only time you use section 11E if there's no cost price. Okay, I hope you understand for the student who asked the question. Okay, guys, any other question? How are your marks looking so far? It's not looking bad. It's looking good. Okay, when will you get your marks, guys? You'll only get your marks after recess. Okay, marks are not looking too bad. Okay, you're welcome for the student that says they understand. If you would like to put your mic on and ask me a question, you're also welcome to do that. So another thing, students, if you did very well in test 1, that is great. Don't think tax is easy and now you stop studying for tax. You need to continue the way you're doing it. You need to study, you need to attend class because it's just more and more and more work that comes your way. Okay, so just remember that as well. Okay, students, so I will be here for any other questions, but if you want to leave, you're welcome to leave. And please remember to attend the face-to-face classes this week.